And interestingly, Andy, from the point of view, looking at what's going on in precious metals, gold is just moving sideways. Silver has got, a nice bid under it, actually. I mean, it really feels firm. And I look forward to your market analysis on this. But if you look at both those precious metals, they should be coming off in the summer months, basically, because the establishment will want some cheap stock or to market on their shorts or whatever it might be. It could happen yet, but there's no sign of it. It's just remarkably firm. And I just get the feeling that anything coming into the market is just taken. So over to you on the market.
Again, silver provides a window. It's obviously, gold is much more complex to follow. The footprints are much easier to read. But the thing is, I think that, and we were talking about 35 resistance. Now that's become support. And in fact, even 36 looks like support. So why is that? And I think what it is that personally, I believe this, and we track our liquidity providers in Asia, and what it's happened, I think that silver has a sufficient open interest, or let's just say there's sufficient COMEX open interest and LBMA open interest that has now escaped into the physical markets. I think it's jumped the ring fence. I think they're having very, very much trouble in keeping silver down. And I think it's almost, and to me now that kind of raises, you mentioned 2020. If we look at gold in 2020, we had 800,000 contracts of open interest. And I know you follow this closely. Now we're around half of that, maybe a bit over half of that. And some of that is momentum short positions. So, and yet, as you know, the gold price continues high without that open interest. So I think what we're seeing in silver, it's, I believe, jumped sufficiently out of their tentacles, of their control, for the price to be determined in the physical markets, where you have to own something before you can even sell it. So now I think the same thing is about to happen in gold. We're seeing that open interest really dwindling. We see it evaporating. Where's it going? It's not evaporating. It's a finite equation. Where is it going? It's going into the physical markets. So then you've got the unwind of leverage, hence the price increase. So I think that silver is providing the key to what we're seeing in gold, which is it is going to also exit itself from the controls of the LBMA CME, who have been sitting on that between them for 50 odd years. And I think when the physical markets are being determined somewhere else, and you can try and delay Basel III all you want, in the US, all that's going to happen is you don't adhere to that. You continue to play paper games. Well, when the liquidity has flowed out into the physical markets, and they turn around and just simply say, give it to us then. And then essentially, unless the COMEX ultimately becomes equally Basel III compliant, every ounce is going to vanish.
That's interesting. The other thing I did notice is that in 2023, China exported an awful lot of silver, and to my mind, was suppressing the market. And the thing that was interesting is that amongst the largest takers of this silver were places like Hong Kong, Singapore, and London, which I would regard as predominantly financial centers rather than photovoltaic manufacturers. Last year, 2024, these financial centers dropped off. There was still a sort of net export from China. I mean, there's no doubt that China, in my view, has accumulated an awful lot of silver. It's been stockpiling it over the years, so it's been controlling the market. But I suspect that's changing. And the thing that's interesting is that perhaps with a very quiet change of policy, I mean, we've seen it with rare earths, very good example. But we're now finding that, silver, platinum, and so on, I mean, suddenly there's a behavior going on there which we're not all that familiar with. Your comments, please.
I honestly believe that's because the price of the physical metal is being determined in a physical exchange, and it's literally. And then you've got the paper open interest, literally exiting to where a real market now. For example, if I'm a producer and I've been financed by the LBMA, and this brings to mind Citi's call for $2,600 gold. And we know, and I'm absolutely certain of this, that they were forcing producers to sell forward based on the fact that they said, well, we think the treasuries, the stock markets are going to do well, that the US is going to boom. Interest rates are coming down. This is their comment. This is their comment. And so therefore, with all of that in mind, gold's going to lose $600 by 2026. And even as much as yesterday, the head of UBS was out there talking about that. It's rubbish. It's absolute rubbish. So they force, and I think the real point I'm trying to make here is they finance a number of producers. Now, if you finance that producer, and you tell him to hedge a position and you sell it forward,
it's the banker.
You're going to take the long side. You've robbed them unnecessarily, because there's no way that with the physical markets exploding elsewhere, being set elsewhere, and them losing control. I really strongly believe that them forcing the producer that you finance, because if you withdraw his banking, his business goes down. So it is a debanking situation. So as far as gold's concerned, I think that is also, I think that game, if I'm a producer, why would I want to be financed by a predatory, after being treated like that? I would much rather take my financing from China, I'll take an ownership position, let them take an ownership position. We'll do much what the BRICS is trying to do, take the barriers down and sit at the same side of the table, and we'll all make some money. So to me, I think that's happening.
That's a very, very good point. And also, of course, the rise in the gold price means that cash flow pressures on mines are not as great as they were. So, I think that, the Citicorps and the UBSs from manufacturers has been given two fingers, basically. I think.
Yeah.
I think what you say is very interesting. There is another aspect to this which I want to explore a little bit with you. We had an announcement, I think it was a sort of, monthly commentary coming out of the ECB about what had happened earlier this year with, the premiums on COMEX and how it sucked in bullion and all the rest of it. And it was quite an interesting article, the way it was written, because it was actually trying not to say too much to upset the markets, if you like. That's the feeling I got. But the one thing they said, the reason that we're worried about this is that Eurozone institutions, their derivatives position in gold have increased 58% compared with the previous quarter, or compared with, previous quarter or the previous year, whatever. Now, this is interesting because tied with this, they mentioned the stands for delivery. Now, I haven't seen anyone else talk about this. I've been talking about it for some time, and we've talked about it together. But I thought I'd run some numbers on this. I mean, the stands for delivery are very important. I mean, basically, my hypothesis is that when it became possible that Trump was going to introduce flat 25% tariffs on all commodities, all imports, the whole lot, the problem for COMEX, operators in COMEX, is that they had stand for delivery obligations. And these stand for delivery obligations were accelerated. Now, nobody really notices this, but they are absolutely huge. Now, I know that the exchange for physical are even greater, but, we don't know whether that's one way or the other way. I mean, it can be both ways. But, we've got hard evidence with stands for delivery. Interestingly, the Bank of England's vaults lost 14 million and 48,000 ounces between the end of October and the end of April. Yeah. On top of that, the LBMA lost a further 7.7 million for a total of 20,751,000 ounces.
Wow. Yeah, that's big.
The stands for delivery in that time, interestingly, were a bit over 22 million. 22,036,500. Now, okay, now you can't necessarily say that these figures are meant to match, but you can see that you've got a problem on one side and you've got a problem on the other side. Now, part of the problem, of course, is that the stands for delivery have increased at a faster rate this year so far than they have in recent years. I mean, I think I'm right in saying that between 2021 and 24, stands for delivery were around about 2,100 tons. This year so far, we're running at the rate of an annualized 1,500 tons. So we're running at close to 4 times the rate, if you like. More, I suppose. Now, the interesting thing, and this is something which I think the ECB is actually worried about, is that all this stuff disappearing from London, how's it going to get back? Because the point about an arbitrage is you do one leg and then you do another leg. And what you might do is you might protect your position by, say, taking out an out-of-the-money call option just in case the price rises too much. But if you've actually, say, taken 20% premium, which at one stage you could do by literally begging, borrowing, or stealing bullion from one centre and selling it into another centre, you've got to get it back because you've got the obligations from where you got it. And this is the interesting thing, because the Bank of England, as I say, you had leaching out from. We had 14 million and 48,000 ounces. Now, this is interesting because I don't believe that bullion banks and hedge funds, whatever, store much bullion in the Bank of England. It's predominantly central banks. Would you agree with that, or am I wrong?
No, okay. You're right.
So what that means is that, the system whereby the Bank of England turns around to a leasing central bank and says, don't worry, you'll earn 1%, whatever the figure is, and it'll, pay for your storage costs, which is lovely. It's lovely for us, lovely for you. And we have a book entry transfer system. So, the bullion stays here, and at the end of the lease, you'll be able to get it back. It's gone. It's gone.
Gold and silver have once again captured the spotlight as America teeters on the edge of unprecedented financial and political instability. With Donald Trump's recent surge in polling numbers despite multiple legal challenges, and the U.S. economy walking a tightrope of inflation, rate uncertainty, and record-breaking debt levels, it has become abundantly clear that the fiat system, rooted in endless money printing and blind trust, is broken. Gold and silver are not just alternative investments anymore. They are lifeboats in a storm of economic and institutional collapse. Every fiat currency in history has eventually failed. The US dollar, once backed by gold, now floats on the whims of policymakers and central bankers. The Federal Reserve claims to fight inflation, yet it created the very problem with years of near-zero interest rates and trillions in stimulus. And now, with CPI inflation numbers still sticky and consumer sentiment in freefall, they've cornered themselves into a lose-lose situation. Raise rates and tank the economy, or ease and ignite another inflation wave. Either way, fiat suffers, but physical gold and silver, finite, real, and time-tested, thrive. In the last few weeks, silver has quietly outperformed many other assets, pushing past key resistance levels while being largely ignored by the mainstream media. Gold, too, is testing all-time highs amid global central bank accumulation. Why are nations like China, Russia, and even Poland buying tons of gold while telling their citizens to hold cash? Because they know what's coming. They know the dollar is losing its dominance and that the next financial system won't be built on paper IOUs. It will be anchored to something real. Trump's return to the headlines isn't just about politics. It's about economic sentiment. His recent statements slamming the Federal Reserve and calling for a return to sound money are echoing louder than ever. Trump understands that Americans are losing faith in the institutions that manage their money. Confidence in the Fed is near all-time lows. The Treasury is issuing debt at a breakneck pace. Social Security is on track to go bankrupt. Meanwhile, the stock market continues to float on speculation, artificially supported by Fed jawboning and tech hype. But beneath the surface, cracks are forming. Young investors are waking up. They're beginning to see the trap. Save in dollars, and you're guaranteed to lose purchasing power. Trust in stocks and crypto, and you're subject to manipulation and regulatory whims. The only assets with a 5,000-year track record of preserving wealth through every war, recession, and regime change are gold and silver. And right now, silver is arguably the most undervalued strategic asset on Earth. Not only is it a monetary metal, but it's also essential in solar panels, electric vehicles, and industrial applications. The supply is shrinking while demand is surging. This is not a speculative narrative. It's a supply chain reality. Meanwhile, America is sleepwalking into another debt crisis. With over $34 trillion in national debt and interest payments now rivaling military spending, the writing is on the wall. The government has no plan to pay it off. The only tool they have left is inflation, silent theft through currency debasement. If you're holding dollars, you're the victim. Every printed dollar makes your savings weaker. Every stimulus check, every bailout, every new government program funded by the printing press, it's a transfer of your wealth to the state. Look at the banks. Regional banking stress has returned, and big names are warning of a new wave of collapses. If even one major institution falls, a domino effect could ensue. And with FDIC reserves under pressure and trust in banks declining, people are beginning to ask serious questions. What happens to my savings if the system locks up? If you can't hold it, you don't own it, and that's why physical metals are making a comeback. Gold and silver require no counterparty. They cannot be hacked, frozen, or inflated away. They don't rely on government promises or Wall Street gymnastics. In times of war, regime change, or collapse, like the world is inching toward now, they are the final fallback. Just this week, Trump warned that America is closer than ever to losing the dollar as the world reserve currency. That's not alarmism, it's fact. The BRICS nations are actively developing a gold-backed trading currency, and the world is watching. The petrodollar era is ending, and with it, the dollar's dominance. Gold and silver will outlive fiat. They have outlived every empire that thought it could print its way to prosperity, and they will outlive this one too. While Wall Street distracts you with AI stocks and debt-fueled bubbles, the smart money is quietly accumulating hard assets. If the monetary system resets, and history shows it always does, those holding metals will have purchasing power while everyone else scrambles for crumbs.